Now, before we get into anything, just want to say Happy New Year and congratulations to you, Zach. Your Georgia Bulldogs just won the college football championship. You're doing too much winning down there in Atlanta.
I know. I know it's something in the water down here. We seem to be able to kick some butt this year. We had the Braves win. Well, this year we had the Braves win the World Series, and the Georgia Bulldogs won this week. So my kids are pretty happy. They actually got to wear Bulldog shirts to school, and we do have a neighbor kid who's an Alabama fan, so that was also kind of nice.
That feels good, I'm sure.
Yep.
Well, that's awesome. Well, hey, what a great way to start the year down in Atlanta. And man, to say that it's been we've got a nice start here to the markets here. We're just talking ahead of the call, a nice rebound here. What is on your mind for 2022, Zach?
Yeah, so it's really interesting to see how all of these different themes are playing out. And, it's not that different than what we were talking about as we were heading out of 2021. So hopefully some of the picks, recommendations that we've been making have been making you guys money, because it's exciting to see some of the names that we've been highlighting have actually done really well. And hopefully we've been able to help you guys sidestep some of the danger out there, because the landmine that is the low earnings or the no earnings tech stocks, those have been really exploding lately, not in a good way. And, we talked about those ahead of time, and hopefully you guys were able to sidestep some of the dangers out there. So some of the rapid fire areas that I'm watching right now, the first is inflation. And J-Rod, who said we are always on top of what's going on right now. And as we speak, the inflation report is hot off the presses. And for the year, we actually saw the CPI, which is the Consumer Price Index. It's the measure of what people are paying for the things that they buy. The CPI came in at 7%. In other words, inflation has hit a 7% level, which is the highest level that we've seen since 1982. I believe it was June of 1982. So we're like 4 months short of a 40-year record in inflation. It's scary actually, and it's definitely it's a theme that we talked about. Last year the word that people used was transitory. Inflation it's going to get better. It's not that big of a deal. It's just a temporary issue. No, it's not a temporary issue. And what we're seeing more and more is that this issue continues to be something that we need to protect your account against, or your wealth, your investment, the money that you've worked so hard to save. A lot of people point to core inflation instead of headline inflation. And core inflation is basically looking at the prices of things that don't include food and energy. I have to roll my eyes at this, because you can't just decide today that I really don't care about food and energy. You still have to put food on the table for your family. At least I do. And you still have to get where you're trying to go. So even though those prices are a little bit more volatile, they still count. They still matter. But even without food and energy, inflation was up 5.5% over the last year, which is the highest level that we've seen since February of 1991. So again, that's what, 30-year high. We're 2 months short of a 30-year high for core inflation. No matter how you look at it, inflation is higher, and it's really a difficult process. I was reading about there was a small business survey that's taken every single month, and it's really important to see this, because you can see what's going on in kind of boots on the ground, what small business owners are worried about. And right now they're saying that inflation is the single biggest problem they have to deal with. They obviously have to pay more for the materials that they buy if they're a manufacturing company, but also the cost of employment, just keeping workers happy, hiring the new workers that they need to grow their businesses. That's just moving higher and higher, and it's causing even more difficulty for small businesses. And then there was a report that I read that was it was sponsored by Bloomberg, but JP Morgan actually put it together, and they were talking about the different styles that do well in inflationary period, how investors make money or don't keep up with the challenges. And they were saying that passive investing, this is where you just buy the S&P 500. You buy like SPY or a mutual fund that follows the index. That's one of the worst ways to invest during an inflationary period. And that's just because the overall market, if you want to call it the overall market, doesn't necessarily trade higher in line with inflation. And so you might end up with your wealth actually losing its value. Even though your money is going higher, you might have more dollars than you had before. Those dollars don't go as far. So this is very much, we're moving into a stock pickers market. And, you know, J-Rod, as I look at this, that's an exciting thing because I love being a stock picker. I love being able to look through the different areas of the market and find what's working, what's not working, and how do we focus our investments on the things that work the best. Another area I want to talk about really quickly is the job market, and just how transient the job market has become, how people are looking for new work. A recent report that I read said that 23% of people intend to quit their jobs this year. And the main reason why they're going to be quitting their jobs is because they're looking for higher pay somewhere else. So this does tie to the inflation story that we've been talking about. Basically, people they know that if they quit and they go somewhere else, they are going to be able to make more money. In fact, I think it was something close to 10% of people have already kind of identified the next job that they're going to be taking. So they're just waiting for the right time to pull the trigger to drop that resignation letter on their boss's desk, on their boss's virtual desk, we'll say, because one of the details with this report is that people who work from home are more likely to quit than people who work in, actually at the office. And that makes sense because they're not as, as attached emotionally to the people that they're working with. J-Rod, you and I, we're working from home right now, but we're talking on a daily basis and we've got a great team that's really in touch with each other. But that's not the case for a lot of people who work from home. But this also is an important point that I want to make about inflation, because one of the things that the inflation naysayers have been talking about is how we see a lot of inflation with tangible goods. And that's because they're saying that's because of the supply chain issues, and those issues might get resolved this year. And so maybe inflation isn't really going to be that big of a deal because the supply chain issues will cause inflation for goods to go back down. But this data about jobs tells us that people who are working from home are requiring higher pay. And that ties a lot closer to the service industry. And it means that workers are going to get paid more. It means that businesses are going to have to pay them more. And since employment is a much higher percentage of the expenses for service companies, it means that service, basically prices for the services that you buy will continue to move higher as well. All of that's just a roundabout way of saying inflation, both on the good side and on the service side, is going to continue to go up. The writing is on the wall. It's really hard to get away from that argument. And so be careful. Don't listen too closely to the Pollyanna people who say, everything's going to be okay. Everything's going to be okay if you manage this carefully. But this is a very important time to be very proactive with how you watch your wealth, so that you can protect yourself from inflation and you can actually benefit during this really different scenario than we've seen before. Inflation is not something we've had to deal with for really almost 20 years. Or more than that, but certainly since the dot-com crisis, and then we moved into the financial crisis, and for that period of time, interest rates have been exceedingly low and inflation has been low, and so now we're dealing with an animal that a lot of people haven't really known how to deal with up to this point. So it's important to pay attention. That brings us to interest rates, and we've seen a lot of the. Congress actually was reconfirming Fed Chairman Jay Powell. So he was on Capitol Hill talking a lot about interest rates just this week. And we're seeing the bond market react strongly to inflation. Now, why should you care if the bond market is reacting or not? Well, it matters to a lot of retirees and it matters to people who care about their income, because bond prices are moving sharply lower as interest rates move higher. This hopefully is not something that surprises you, because it's something we've talked about a lot lately, but I still want to keep kind of pounding the table on this. We're not anywhere close to being done with this risk. So if you have treasury bonds in your retirement, those need to be kicked out, especially the long-term treasury bonds, 10-year treasury bonds, 20-year treasury bonds. Those need to be out of your account because they are so vulnerable to higher interest rates right now. One thing that many people don't realize is that if you have a target date fund in your account, let's say you're going to retire in 20 years or 10 years or 5 years, and you have a target date fund in your account, that fund will invest in treasury bonds. And the closer you are to retirement, the more that fund invests in treasury bonds, just kind of as a mathematical um, formula that they use. So as easy as that is, like, it'd be great if you could just set your money in one fund and just leave it and let it go. That's actually a really dangerous way to play right now. So be on the alert for those funds in your in your 401k account, in your IRA, and I would say get out of those. Let's be a little bit more proactive with your investments so that we can make sure that you're not hurt by higher interest rates and lower bond prices. And the other thing to just say that higher interest rates are actually causing these no earnings or low earnings speculative stocks to trade lower. I was looking at some of these stocks lately, and just over the weekend, I kind of browsed through a whole list of these speculative stocks, and it was tempting, even for me, like knowing what's going on, it was still tempting for me to say, these things are down so much. I'd really like to think about buying them. And this gets back to the waves versus the tide, but the tide is still very much against these stocks. And some of these stocks are still trading after falling so much. They're worth 10 billion, 20 billion, 30 billion dollars, and the companies are losing money faster than they can find it. And now with interest rates higher, it's going to be even harder for them to raise the capital that they need. So just because a stock is off 50% or 70% or 90% from where it was trading before doesn't necessarily mean that it's a good buy. In fact, it could be going to zero. So just still be careful. The old Wall Street saying, the man who tries to pick bottoms ends up with smelly fingers. It's not the best example, but you definitely want to be careful trying to pick up these stocks. The other analogy is don't catch a falling knife. You know, these stocks are still trading lower fast. Don't grab that knife. You're going to cut yourself. We're not at a place where you can buy these stocks for the long term because higher rates are still going to make it difficult for them. So that's what I've got prepared for today. Obviously, we're in a very dynamic period of the market. It's an exciting period of the market. And I would just reiterate, be a stock picker. Don't be an indexer. Indexers buy the S&P 500. Stock pickers find the gems in this whole group of stocks, and they buy the individual names that will do the very best for them. This is a time to be a stock picker.
Man, could not have ended on a more potent note. But that's great, Zach. Thank you so much. You know, covered a lot of ground, today, and you know, as always, we always have a lot of ground to cover. But this is a time where people should really be thinking about what's in their retirement account.
Yep, for sure.
Well, Zach, any other final thoughts before we go? You got a big, huge congrats to you.
Go Dogs! Yeah, I'll just say go Dogs. We can be stock pickers and we can be individual team pickers, right? Well,
yes, we can. Yes, we can. Well, Zach, thank you so much as always for another fantastic call. I'm J Rod, and we'll see you next time.
See you guys. Thank you.